Just when you think it is crazy, it absolutely gets crazier, and this is no joke, ladies and gentlemen. After Kevin McCarthy gets ousted here, it looks like Jim Jordan could be a setup to be a fill-in for this position. Hamas just launched an attack on Israel, and if anybody knows, our relationship with Israel is extremely important and extremely strong, which means the US is most likely going to get involved here. We have to pass bills, and we have seats to still fill. So this is an absolute disaster right now, and who knows what's really going to come of this. But I definitely think the United States is going to step in. And with the global tension, this is part of an end of an economic cycle here, ladies and gentlemen. We've talked about it numerous times. And yes, it's starting to unfold here. High inflation, a Fed tightening, political tension, these are all end of cycle behaviors. Now we throw in the inverted yield curve and bank collapses. It's pretty clear that we are at the end of a cycle. And if anybody is saying anything different, hasn't studied cycles before. On this channel, we talk about stocks, so I'm not going to get into the politics of everything, but we're going to talk about some stocks here that you really need to consider adding to your portfolio. And now, with these things kind of erupting here, it makes it more important than ever to have some sort of portion dedicated to defense and energy. And so while the market is down slightly here, we can see companies like Lockheed Martin are up nearly 8%. And when we look at the chart of a company like Lockheed Martin, this was nearly a $500 stock. The multiple on the stock in this area is actually reasonable here. And as most of you know, most of the energy sector is trading for nearly single-digit PEs. And this is going to disrupt a lot of different things. Now, the bond market is not open today, so I tend to think things are going to be fairly mild. And as we went over the technicals were actually bullish. So technicals are holding up here because I do think we have a bullish setup in the overall indexes. Now, that can obviously come to an end with any sort of war talk here. But what is truly holding up the market right now is the fact that defense stocks are exploding, energy stocks are exploding, and that is offsetting the underperformance of other sectors. So in my opinion, I actually think that the market could be down a lot more here. But because of the technical setup and the fact that there's massive overperformers in energy and defense stocks, we're seeing some stability here, but I'm just not so sure it's going to stay. So while I still believe in the short term, the technicals are actually pretty strong here, it's going to be interesting to see how this plays out. And that's why I've said we have to play it day by day here. But if we were just to come into the day and know that Israel was attacked, energy prices could be skyrocketing, we would think that the market would be down substantially. And that is actually not the case. So what I want to dive in today is actually Raytheon, ticker symbol RTX. This is a company that I think could have a good opportunity here. Now, when we look at the current PE ratio, fairly elevated, trading at 19 times earnings, pays over a 3% dividend. And yes, now all of a sudden they are extremely important. But when would have been the best time to buy them? When nobody wants to own them. And that's why I've been really pushing defensive stocks. And if we've seen what I've been talking about on the channel, companies like CVS, companies like Conagra Brands, companies like Campbell Soup, these are all overperformers today because when things get uncertain, these are the areas that we want to own. And when do we want to buy them? Well, we want to buy them where they are the cheapest and paying the highest dividends, right? And so the opportunity would have been a few weeks ago to start accumulating these at 52-week lows, and we're starting to see these stocks now come alive, which is why it's important to diversify your portfolio and understand what you're owning and where we are in the cycle. Now, take a look at the chart on Raytheon. Got thrown out, nobody cares about it, was unimportant because when we're in a bull market and it's all about AI and technology and multiples expanding, people are going to throw these types of stocks to the hip side. But all of a sudden something happens and they become the most important stocks in the world. Is there anything more important than defense spending when we go to war? Absolutely not. It even takes precedent, in my opinion, over food and shelter. So now is the time to own these companies. And they are fairly reasonably priced when we look at a forward mechanism here. Now, I'm going to plug in Raytheon personally here. But what I want to point out is I looked over their balance sheet, and the balance sheet is fairly questionable. It's not the strongest of balance sheets. But what they do here is they pay dividends, and they've grown those dividends consecutively for 29 years. 33 consecutive years of dividend payments, 29 years consecutive of dividend increases. And with this macro backdrop being at the end of an economic cycle, these stocks are normally going to outperform the overall market. Throw in the fact that there's probably going to be an extended war taking place here and that the United States is going to have to participate and start spending. The money is going to go to these types of companies, which actually makes their valuations fairly cheap on a forward basis once again. First thing we want to look at is sentiment here. We have a low of $75 and a high of $117. Currently, the stock is trading right around $72, $73. Now, here is the funny thing. All the experts are initiating a hold at around $80 a share, which is probably where they think fair market is. But now with this going on, you know that if they could go back to the drawing board and they could buy this at a 52-week low, they would be initiating buys here around $75. Now they are expected to grow revenue right around that high single-digit rate and getting right around $94 billion of top-line revenue by 2027. When we think about China and Taiwan, we think about Israel, we think about Russia and Ukraine. Defense spending is probably going to be a top priority going into the next few years if none of this gets resolved. And I tend to think that this is probably undershooting what they can do, but we're going to stick to what is out there right now. We can always speculate in the future, but let's use what experts believe growth rates are going to be. So I do want to point out top line revenue growth, but we can see it's very cyclical. This is a cyclical business. You want to own them when they are a hot commodity. And going into an end of cycle, I kind of dropped the ball here. This is probably an area that I probably overlooked a little too much, but this is when you do want to own these companies. And as I showed by Raytheon, it's basically trading at a 52-week low. So that's why I'm diving into this one a little bit here. Had a substantial sell-off, has been paying a dividend for over 30 years. So this is specifically why I'm diving into this one, because I tend to think that there could be some deep value here. When we look at valuations, I think it's fairly reasonable. Yes, it's a little overpriced probably, but when we think once again, the company sold off drastically. Now, once again, defense stocks overall have been selling off, so the multiples are compressing, and it's really hard to figure out exactly what kind of multiple we want to put on this stock. So I'm going to give it right around a $65 to $75 price target, ticker symbol RTX. That's basically where I get, I think it's really interesting when it breaks below $70 a share. It's gotten as low as $68 a share, and during the pandemic, it was trading in the 50s. So during the pandemic, trading in the 50s, currently trading around $73 a share. Obviously, on a day like this, I think the momentum's still going to be to the upside. If news keeps on coming out that we're going to have to participate in this war, we're going to have to start spending, and companies like this are definitely going to benefit. And so we can put a little bit of a higher multiple on this, as this is a cyclical business, and this is when they tend to do their best. But from a historical standpoint, I think it's at actually fair market value here. I'm not saying you're getting a screaming deal, but if you're looking for a double-digit rate of return, I think buying it under $72 makes a lot of sense here. Reinvesting that 3.5% dividend, and I get a fair market value of $174 by 2032, which is really not outrageous, as the 52-week high was sitting at $104. So I think this is a pretty interesting stock to add to your portfolio when it dips or when it's getting overlooked. Probably on a day like this, maybe not the best time, but I do think that maybe the stock has recently found a bottom here. So as always, appreciate everybody's time. Thank you so much for spending it with me, and we will see you in the next one. Peace.